Don had mentioned wanting to discuss investing in volatility products, and he knew I had done a little bit and asked would I share some of my trades. And he knew about this one because back in April I posted on the Meetup website's message board that I had, and I don't sit there and watch time and sales go by all day long, but I just happened to notice one morning that a 900 lot butterfly in VXXB, which is VXX volatility, were traded. And I thought, well, whoever is buying 900 butterflies knows a lot more about what's going on than I do. So I figured I'd jump in at it too. And this is what it is when I started out. And the dotted line represents market. And the reason I kind of like this is because if you noticed the options, the puts being used are for next January. I did this in April, so I got what, 9-10 months of time. The underlying is, I hate to say this, but it's practically guaranteed with the exception of occasional surprises. So I just figured if somebody knew enough to do 900, I'd try it. Next slide. And since they saw me jump in, a lot more people jumped in. I don't know if you can see those numbers or not, but that's 3,000 of those butterflies exist out there now. So there's a lot of people, I don't know whether they jumped on it because I did or because the first one did, or this is just something that the professionals know about and all do together. But yeah, the two long positions both have over 3,000 options, and the shorts double that, over 6,000. So that's a pretty sizable trade. Next slide. This is where it is today, so I'm losing money. Does everybody understand this risk graph? I think I'm down. Okay. Here are where the three options are. This red line is what the profit and loss is of this position as the market moves up and down. So if the underlying VXX moves up, this line slopes down, I'm losing this amount. Okay. Get in here, I'm breaking even. The trick is, dark line is where the red line's headed with time. So every day between now and expiration in January, this red line is going to be inching up. Okay, and it'll even pull this line up out here for a while. But eventually it'll look like this. So anytime I'm under here, I wouldn't hold till expiration. But if I got down, well, I think the next slide kind of illustrates this a little better. Here I show this line progressing up at a rate of every 59 days. So if I'm here, 59 days later I'm there, 59, 59, another 59. So the rate of profitability increases with time. You know, the longer you hold on it, the faster it's building. Does that make sense? Well, like I say, I'm down. I think it's, put it down. I'm down $125 on my $1,500 investment right now. But I'm not too concerned because I'm betting that 6 months from now, I'll be in that area in here.
Sell versus buy the fly, how would that change your graph? It's one of the questions we had online.
I'm not sure. If I I bought this. Okay. If I sell it, it's just an invert. This peaks down here. But anyway, what my hope here is the underlying being what it is will decrease with time. So I'll move down this way, and at the same time, theta, or the decay of the values, going to increase. And I'm not, I mean, if I'm lucky and I'm right here on that magic expiration date, I've made $2,500. But I will be happy making $300 or $400 on this.
So let me ask Tom, if it moves in there toward the end, you're going to be better off because as you get closer to the expiration date, the line will be higher.
Oh, yeah, yeah. As you get into here, you definitely, as the closer you get to expiration date, the more you want to hope you land up in this area here. Because if you're out here, you're going down. And I'm at a loss right now. At some point, if it goes totally against me, and I keep inching further up in price, down in profit, I'll have to make the judgment call. I'm too far away now, and the chances of getting back in there is not good. So, you know, part of the deal here is you got to know when to just cut your losses and run. I'm not advocating this as a trade to put a bunch of money into or to do over and over and over every year. I just saw it go by. It interested me. I said, I'll put it on and see what happens. I found that I can put a small trade on and become invested in it. And I mentioned I'll follow it. I'll track it. I'll bleed with it. But if I just paper trade it, I'll forget to even go back and look at it. So this is just an experiment, see what happens. Hopefully I'll make a little money. I think I will. Okay.
Okay, maybe we should get questions on that. Are you? Oh,
Let me show one. Let me make one comment first. Right here, this is the VXX price chart. Right there is where I was when I put this trade on. And you can see we had the wrong move. But I'm on, you know, we're sitting out here right now. I'm down $125. I'm not too worried.
And did you explain why why one normally expects I think you probably did, right? The VXX to continually go down?
Well, just the way it's structured. It's a play on today's volatility. And I'll get more in that in a few minutes. But yeah, there is a general expectation that VXX will decrease with time. And you can see, it certainly has, with occasional surprises when the market gets volatile. Go ahead to the next slide. How many people here are into aramir.com or used to be Capital Discussions? Okay. There's a weekly forum on there called Beginner and Small Account Trading Groups run by Tim Pearson. And these are archived out on their website. You can, if you're not, I don't know if you can access them if you're not a member or not, but they're also out on YouTube. So you can do a search on YouTube, and if you can't, you know, you can find it there. But this was back, I went into the library on the website, put in August 24th, 2017, because he had a very interesting guest speaker on that day, a fellow by the name of Russell Rhodes. He's the director of education for CBOE and was a friend of Tim's. And he talked a lot about different, he went through what the VXX was and went through a lot of ways to trade it. Next slide. One of them is a call credit spread. Okay, and again, here's your line, and it's going to move up to the top. If you understand options, this is not strange to you. Next slide. This particular trade's kind of like what I call a campaign trade. It's a trade that's got a fixed set of rules. You can put them on one right after another continuously. And if it's a good trade, you'll make money. I don't know whether it's a good trade or not, but I trade these things like this small, and I trade them consistently. I've been 1, 2, 3, 4. I've done this trade 5 times now over the last 2 months. I made $94, lost 20 something, made 70, lost 60. Does that say I lost a penny? 3 cents, okay. So I'm $89 ahead, 2.7% gain. The rules I have up there at the top. This trade goes on every Thursday, last hour trade. Expiration is next Friday, 7 days away. You sell the 40 call, buy the 15 delta call. And you hold it to expiration. Yes. Well, it's you put it on by delta. In this case, it was the 26 and 29, so it's 3.
So it's about 3. All right.
Yeah.
So this is selling a call spread.
It's selling a call credit spread. Yes.
In other words, you're betting on the usual habitual tendency of the excess
Right.
to lose 5% a month.
Yeah. And the trick to this is going to be knowing when it's going against you. And that's why I'm trading it small. $28 loss, $50 loss. You got to get out if it's not going right.
So he's saying just do this every time.
Every week, yeah.
And so he's selling a spread. What would be the difference between selling a call spread, whereas you are, and your trade that you showed just a minute ago?
Well, the other one was a butterfly, right? Okay.
And the reason you would take a butterfly is because it's more precise. Selling a call spread or buying a put spread, you're going to have to pay more if you're buying or take more risk theoretically.
Well, back up 2 slides. I mean, this one, the difficulty with this is you can't let the market get above where your short strike is, because you start losing money. Okay, so if you put this trade on and the market stays here or in this area or goes down, which we expect it will because of the underlying, you'll make maximum profit. The trick, and the statistics work out so that more time you win than you lose. But that's if you don't lose a lot. You've got to be smart enough to know when, oh, this is not going to work this week. And that's why I'll trade this for several months. Take my licking on occasions. And if you go through some of the educational materials, there's a way to adjust this. You know, you can shift the spread a little bit, roll one of the options. I'm hoping not to do any of that. I want this simple. I put it on. I either make my money or I get out before it goes to hell. Okay. Now skip forward to. Oh, okay, back one. The other one that Russell Rhodes mentioned was just buying a put and have the money put and let the decrease in value bring the value into the put. So now I would normally put this on right here where the put I'm selling or buying is at the current market price. So assume this line is here. As the market goes down, you start working your way up this line. Okay. Same time decay is getting that line's going down. So it's a balance between the proper price movement, quick enough. Again, success of this is going to be, do I do it enough times so that I know when the best time to get in and out of there? Next slide. So I did it once with 5 puts at the 30 strike, paid $6.75 for a total of $3,375. A month later, I sold it for $8.64. So I ended up making, what, $900? And then I went ahead and did it again, this time further down because the market's moved. I'm at 25 now. Question? Again, I'm keeping a log of these trades. So I'll know 6 months from now whether I want to continue or not. Okay, next slide. Another one that Russell mentioned in that webinar was a 90-day put debit spread. This is where you go out 90 days to expiration, you buy the 50 delta put, sell the 30 delta put. I've not traded this yet. That's next on my list.
I mean, it's sort of a variant of your butterfly. It's just using a put
Exactly.
debit spread instead of a butterfly.
Again, this is all in this beginner and small account trading group webinar from August 24th of 2017. Next.
Yeah, the video's online. If people want to,
Yeah.
if people can't find it, email us or post somewhere, anywhere in any of our places, and we'll help you find it.
Another thing that I've stumbled across, and I think the guy that did this was with a small outfit and they kind of went out of business or sold it. Now OptionView is running this, but it's a trading system on the VIX or the VXX. You subscribe to it, you're either long VXX, short VXX, or the appropriate product, or you're out. And you only make that decision 3 or 4 times a year. And they've been getting about 30% a year. But if you go to their website, they've got a little 20-page booklet that is really neat because it explains how the volatility products work and why VXX goes down every month. And they actually take briefly every day the people that run the VXX ETP, I guess it's called, they have to sell one future and buy another. And the way it's structured, they're almost always guaranteed to lose. Okay.
Because of the contango, they're buying
Exactly.
high and selling low.
Yeah, so every day they lose a little bit of money, unless the futures term structure gets out of whack. They've taken that difference between the two monthly contracts and subtract them and come up with so many pennies are lost every day. And they keep a record of that and have built an index based on the difference. So when it's flat, it's not much of a difference. When it really gets in contango and it's steep, it's a bigger number. And they've built an index out of that. And they explain it all right in here. And I haven't been through it enough yet. I mean, I've read it twice. I usually don't understand anything good till I've been through it at least 5 times. Yeah.
So when are they going to go out of business if they're losing a few pennies?
Oh, good question. Good question. VXX, if left alone, is slowly declining towards zero, but it never gets there because at some point they do a reverse split. I think it's a 4-to-1. So when it gets to like, I'm thinking somewhere around $10, they'll do a reverse split, 1 for 4, and the new ones will be worth $40 then, but you have less of them. So it never goes to zero. Since its inception, I think it's a split 7 times. And each time it's 1 for 4. So if you go back, the value of VIX now is like, say, or VXX is $28 a share. If you undo that split going all the way back, that represents like over $100,000. Because it's 4 times 4 times 4 times 4, 7 times. Anyway, if you want to trade this, they will give you the signals. You can join them, pay a little fee. It's $10,000 a year. Boy, talk about wiping out my account. But I think the paper that they have is, if you're interested in this type of thing, it's great reading. And like I say, I think there's enough information in here, you could almost do it yourself.
Yeah, Tom, I know that system. That came from OptionView originally.
Yeah, Lynn Yates, I think his name was.
Yates, yeah. And it has had a checkered past.
Oh.
I still think it is absolutely valuable. You're absolutely correct to look at it.
Mm-hmm.
And I think you're absolutely right. What you want to do is adapt it and change it and make it your own. Because the history of that, it keeps having problems, and then they redesign it, and it's, oh, well, now it's fine.
Yeah. Well, the way you read it is they've improved it each time, But it's interesting reading if you're into this kind of stuff. There's a lot to be learned right there. Unfortunately, to get this, I think you have to go to their website, give me your email address, and then you're forever bombarded. But if you'll send me your email, I'll send you a copy of this. It's not copyrighted, so I have no qualms about doing it at all. And that way, nobody gets your email address except me.
Okay, and how would they do that, Tom?
I had that coming up.
Okay, good.
One more thing. And I'm trying to think when, November 8th, 2017, right here, we had, I don't remember the guy's name from Option Pit.
The German guy?
No.
Oh, Mark Sebastian?
Yes. I didn't attend. Wished I had. But he talks about trading the VIX and the VIX ETPs. The meeting that was done here is supposedly archived at Aramir, but it's not. I don't know why it's missing. But it is on YouTube. If you're interested in something like this, you can go there and view it. There is 40-some pages in the presentation. I cannot find that anywhere. Whether you'd have that, Don, I don't know.
Oh, yeah, I should have that. I'll find that and send it to
Because
you.
it's not on, I can't find it on the web. Air mirrors,
I have every presentation
I
that
figured,
anybody
yeah,
ever gave to
that's
our
what I
group.
was hoping. But this has got some excellent reading in it along that subject too. Any questions? That's all I have. I just wanted to bring a lot of things and point you in the right direction.
Oh, we appreciate it. Thank you very much, Tom. We want to make sure that people understand. Oh, thank you.
Your email. Thank you, Tom. That's fantastic.
And will you make some slides available, Tom? Or are there not any, really?
Yeah, I mean,
Just a couple or whatever. He's got it anyway. Okay, fine. THOM, or let us know if you have any problems. Now, it's only good if people understand. It's no good if people get lost. Who's lost? Who's lost on this so that we can add some clarification? Okay, let me get closer to this gentleman here. Let me get behind him, I think. Yes, sir. What are you following at all? Or?
No.
Okay, well, let me try and paraphrase what Tom has said. I'm glad. I appreciate your saying that, because let me paraphrase it and see if this makes any sense, and then Tom can tell me that's not what he meant at all. But there is an ETF called VXX. First of all, do you know what VIX is? The VIX itself is the fear index. Tom mentioned it, and VXX tracks the VIX. So in other words, that was the original intention. In other words, they said, heck, a VIX, it goes up, goes down, right, tends around at very low of maybe 8 or 9, and it goes up to 10, 12, 13 every time you have a panic of some kind. It goes back and forth. Now people need to protect their portfolios against crashes. And therefore, they need to protect their portfolios against rises in the VIX. So VXX is an ETF that they can buy, and it will mimic the VIX. So let's say you have a large portfolio of stocks. Let's say the stock market crashes. Let's say what's going to happen? The VIX is going to go up, right? It's going to go up to 15. Who knows how high? It could go to enormous heights if it crashes suddenly and hard. And then it'll come right back down again. But so the VXX is simply an ETF, just like any other ETF, or it's an ET or an ETP. Anyway, it's basically an ETF. And so you can buy and protect your portfolio. But instead of just buying to protect your portfolio, what we're talking about is a traders group. Let's trade it instead. Let's trade it. Let's get in and out. We think the market's going to crash. Let's buy it. Then let's get out. Only instead of necessarily just buying the ETF itself, the note, whatever, let's instead buy a put or a butterfly, or a bear spread, or maybe we'll sell a call spread, all the same thing. You're basically buying protection theoretically, or more exactly, buying a number that you expect to go up. Does that make sense? And Tom showed us a number of different ways of doing that with either a put, or you can buy, a spread. And that's all. Does that make any sense? Okay, great. Now, let's see, where are we? So who has more technical or other questions for Tom? Yes, Will.
Provide the VXX. How do they make money?
The design of the VXX is to represent not just VIX, but the 30-day volatility of the market. Okay. So they create a product that is supposed to mimic whatever the 30-day volatility is. If the volatility goes up, then VXX will go up, the 30-day volatility. How they do that is by buying and selling these future contracts and balancing them so that they've got a 30-day equivalent. I was heading somewhere with this. So if you are afraid of, why would somebody just buy the VXX? If you have a large position or a large portfolio and you're worried about protecting it should it crash, because when the crash happens, your holdings are going to go down. You could instead, to protect that, you could just buy some VXX. Okay, so when this crash occurs, your portfolio goes down, but VXX goes up and offsets your loss a little bit.
How do they make money?
Oh, yeah, the fund is losing all the time. So how do they make money? It's because of the amount of trading activity that is generated buying and selling these ETNs.
They never take a position themselves.
Yeah,
It would be totally improper for them to do so.
but yeah, it's one of the few ETN products that the underwriter is guaranteed to lose a shirt on, but yet they still make money. Magic.
More questions? So basically, it's a matter of trading. Well, let's see what we've got online here. This is a fee applied. Yeah, fee, that's what we just said. There's a fee applied with his expenses. And he says 0.8% per year. Fee is, well, he looked it up, the expense ratio. That's one of the online people. 0.8, thanks, Gary. 0.89% per year. Okay, thank you. I think the other question we're answering all as we go here. And now we also have another, Jim Hadley is also going to show his, some of his trades in volatility. Let me, Jim, first of all, before we do that, just give it, I was originally going to give a longer talk, and I'm delighted to cut it back in favor of the experience that we're getting from a couple of our members. I will cut it back, but I will just start into it briefly here. And Ryan, if you want to go forward and see this, just at the moment, how can we talk about VIX without talking about what it's like right at the moment? And so let's look, this was yesterday, and this is the different months. Remember the VIX, as Tom explained, is 30 days out. It's an average of futures contracts. Here is the implied volatility of the price of the VIX, rather, the price of the VIX. And VIX futures, totally irregular. We could talk about this for half an hour. It's supposed to gradually rise from the lower left to the upper right. It isn't right now. It was in huge backwardation very recently, and now it's correcting itself. And anyway, that's VIX Central is the place to go if you want to look at the term structure of the futures contracts. This is tremendously tempting here you could arbitrage that with a butterfly. Anyway, look at the next one, please. Here are some of the ETFs. VXX is just one. Others are UVXY, SVXY, and VIXY. Let me ask Jim. We saw that Tom was trading. Let me ask Jim what ones he trades.
I trade SVXY, but
We explain what that is.
that's the inverse of VXX.
Stands for short. So S is one of the main ones you trade if you want to be short. In other words, in this case, instead of buying a call spread or buying a butterfly below the market, we're saying instead we'll do that inside ETF is taking care of being short, and so you can buy it. This makes retirement accounts to buy it because they can protect long. But, or why do you, let me not put words in your mouth. Why do you like that particular ETF?
I was going short VXX, but the risk of holding it overnight and having something catastrophic happen could wipe out your account.
So you can get in and out, and you can jump back and forth between the two of them, you know, during the day if you want to. UVixie and the SVixie are twins; they'll wear you out. So it's a lot of fun.
Okay, so do you want to get your laptop ready? Yeah. And he's going to show in a second some stuff. You can, yeah, you're welcome to come up or do it from there. Okay. Can you find on there? Well, hang on. Let's just go a couple of slides more on mine first, Jim. So Ryan, if you could go down, those are the ETFs. Now the key factors. Yes, thank you. The VIX is mean reversion. And that means it's always around, it always comes back to 10 or 11 or 8 at very low, 6 extremely low. Is 6 about as low as it ever got? And it can go up to astronomical values when the market crashes. Now, XX, which is what Tom showed, loses about 5% of the month because of the contango effect. And these are unique trading strategies. Are they true edges? Let's come back to that in another meeting because it's a whole topic of its own. And here is the VIX. And as you can see, historically, this on the left is 2006, and the right is recently, recent month. And as you can see, this was over toward the left, the huge peak is who knows, anybody would know what that is. That's a crash of 2008. And as you can see, we continually have the continuous bunch of, they could be called eruptions, is what they were called last month by our speaker. And see, we got caught, the problem is you get caught in those. And that's actually what we've been talking about in part. And next, please, Ryan. Oh, sorry. Yes.
Just came to me. When you're trading like the spreads, the butterfly or the spreads, these huge spikes come along. The spreads have built-in protection. You can only lose so much.
That is right.
So that's what makes it not disastrous to trade them, is because that line where it goes down, it only goes down so far and flattens out. So that big old spike, you only suffer the first part of that.
And let's explain to them too while we're explaining things here. Why it is not risk-free then to simply buy one of these ETFs. In other words, if you simply buy the XX, why is that risky?
Well, a volume spike like that'll.
Right, because it'll wipe out your whole capital.
Oh yeah, that's why you need the spread to protect you.
Yeah, or there are, yes, thank you, Tom. And so let's go down another one, please. VIX and SPY. So this is just showing, this was the crash in 2008, the big bump of the big crash in the graph. On the upper graph and the lower graph, you see the VIX reacting instantly, immediately, simultaneously. Okay, next please, Ryan. And next please. Those are some links to another prior meeting besides the one Tom mentioned. Next please, Ryan. And I don't think we'll have time today to go back over Iggy's trades. So let me now go over to, no, that's fine, that's fine. Yeah, Ryan, yeah, if you could bring Jim Hadler. If you could, Jim, could you share your screen on there? It should be on the prompt. And Jim actually now has been doing, let's see, is there anyone who knows, can you find it there at all? You can, okay, we're working on that. Okay.
Pick the screen you want to share.
Oh, great, tremendous. And so Jim now has been doing research also. I love it. We've got it shared. Thank you very much. So Jim has been doing research for many years. Is that right, Jim?
Yes, I've been trading full time for 23 years and trading volatility for 6 years. So this is really, it's the third major theme in my trading career.
So you're going to, and Jim is going to show us some of his research results, the system he came up with,
right,
or the trading mechanisms he's adopted, which ETF he's using, and other aspects. And so go right ahead, Jim.
Okay, so I'm going to share one trading system. You can see the rules on this on the screen. So I chose UVXY for this test because it's the only ETF that was able to get 6 years worth of data. So the first rule, short UVXY when the 3-day simple moving average is less than the 6-day simple moving average. Also, when the close is less than the 3-day simple moving average. So those are the two rules. When they're both met, you go short.
So can we just make sure we understand this?
So, and this is on a daily basis, daily bar chart.
Okay, so you take the 3-day simple moving average,
Yes.
and the 6-day, and you want the 3-day to be under the 6-day, and the close to be less than the 3-day, and then you go short UVXY. Go ahead.
Right. So the first rule indicates that you're in a downtrend, and the second rule indicates you're even extended into that downtrend further.
So could you explain again what UVXY is?
So UVXY is the same as VXX, except it is 50% more volatile. So other than that, they're identical.
The U is ultra, I think. Ultra.
Yeah, it was, the U is probably for ultra. So, and there's another one, TVIX, and that's actually a full double the volatility of VXX. So.
That's great. So you got these are the rules for his trading system. So he goes short whenever, on any day, whenever these rules are satisfied, basically, and then but he's got, and these are cover means when he exits. If you can make that larger would be better, but it's okay. Cover when the,
Right.
under these other three rules.
Right. So if any of those three cover rules are met, the position is closed. Oh, yes, average true range. So I don't have the details of the length of it. I think it's 10-day and maybe 1.2 average true range. So I will move now to my TradeStation account. And how do I do that? I can't do it from here, can I?
Yeah, go ahead. Share. You need to share.
Yeah. You want to do it? Yeah. Got to get back to that share page.
Yeah.
Okay, while they're working on that, and we'll just mention that there's a whole variety of systems really for trading volatility. And these are just examples. And as you can see, they all have similar objectives, different means. Go ahead, Jim.
Okay, so this is my TradeStation account, and it's live right now. So this is the most recent 3 or 4 months of daily bar data. You can see everywhere there's an arrow. That's either the entry or an exit into a trade. If you see the blue dotted line, that was a profitable trade. And if you see the red dotted line there, that was a losing trade. So currently we've had 3 losing trades in a row. Most recently, we exited last Thursday intraday because the market was selling off and VIX was spiking. We'd gotten in 2 days earlier. Okay.
So have you been taking these signals?
Yes, I have. I've been taking these for a couple of years now. So this, I brought up a performance chart of how this theoretical system is done going back 6 years. This is using $1 million per trade. So you can see it's 3.5 times. It's got up 100%.
Could you mention those numbers again? Because people in the room aren't going to be able to read them because they're too small.
Okay. Yeah, so it's showing a profit of $3.5 million with the assumption that you're doing $1 million per trade.
So it tripled.
The way I look at it is it doubled 3.5 times. Because the way TradeStation does it, you're doing the same amount on every trade, but in a real portfolio, as the portfolio grows, you put more money into a trade, and as it shrinks, you put less. But they're saying you're always putting that same amount.
Oh, okay. So they don't have any compounding.
Right, no compounding either way.
You're saying you would compound at a certain point.
Right, and as compounding, they're not doing the compounding is dangerous because if they have a 90%, if you have a 90% sell-off in your system, you know, theoretically they're thinking you're still doing the $1 million per trade, but obviously you can't.
Yeah, it's best. It's a very nice system to not have the compounding, which, as you say, because that allows you to. It becomes independent of path, I believe, in that case.
So when I look at an equity curve, the first thing I'm looking at is the drawdowns, and you can see where I have my pointer now. From there to there is it's about a $300,000 drawdown, so that's 30%. So if you were going to trade this system exactly the way it is, you have to be prepared for at least a 30% drawdown at some point.
Which is large, but unless it's part of a larger portfolio, in which case it may be acceptable.
Yes. Yeah. So when you're creating systems, you like to create a portfolio of systems, and you know, you can get that 30% down even less.
So is this a system you would recommend, or are you showing it because it's simple and you have better ones?
Yeah, I'm showing it because UVXY was the one I was able to get the data for. I prefer to trade it with SVXY because you don't have the risk of the overnight shock, where with UVXY it could open up 50% higher, and if you're short, you know, it could be put you out of business.
So would that show a similar curve, or?
It would show a similar curve, yes.
Mm-hmm. Oh, I see. Okay.
But the SPXY has a lot less leverage, so it would be a flatter curve.
I had a question. What's the minimum contract size that you could trade, or the notional value of one contract?
Oh, one share.
Yeah. What's the value in dollars?
Oh, right now, well, UVXY now is at 39 a share.
Oh, well, you could do.
Yeah.
You could just scale down and be small and
Right.
not have to do $1 million.
Yes. So right now, the reason I did $1 million is because 6 years ago, UVXY was at $1 million, and this only doesn't do fractional shares.
Ah, okay.
See, when you go back in time, that, you can see on the right side that it's over $1 million a share, and that's because of the decay. Right.
Same thing as before.
Exactly. I saw the decay and it's like everybody else, how do I capture that?
Could we assume that the market in the last week has been an example of the overnight problems that you're trying to avoid?
Uh,
$200 down days and things like that?
Over a slightly longer period.
yeah, you could see, let's see, going back 4 days, we had a huge jump overnight. And that's what I'm trying to avoid by trading the SPXY instead. What?
Overnight you can sell if it goes.
Oh, yes, with the SPXY, I go long it since it's the inverse. So I can only lose what I put into it. With UVXY, it can double and triple, and you can lose more than your account.
You were shorted?
Yes, if you're short. So and that's the way the system works. It only goes short. Remember from the rules at the beginning.
So SPXY, you're going long.
Yes.
You have to be short.
Yes.
So that's why you don't have that risk, the same.
Right. The SPXY.
The margin exposure, you don't have the.
I do not hedge it. Right. So even in the last month, you see we had a period where this did spike up from 32 up to 46, and that was just a minor sell-off. So, in a major sell-off, it will triple.
Now, how would you compare, let's say, Tom was talking about also, it's trading a butterfly or trading vertical spreads, either selling calls in his case or buy a call spread or buying a put on VXX. How would you compare yours? I mean, obviously you have such rules for enter and exit. Could they be applied just as well to those trades?
Yeah, I mean, you can trade this without use the options. That's one way to you can trade the UVXY and not have to worry about the whole next.
Oh, okay, that's a good point. So you're avoiding options complete, or you're not trading options. You're trading. The reason you're choosing a variety of, or choosing your ETF very carefully, is because you're looking for a way to get short. Another way of doing that could be with options. So who's got? Okay.
So that's it.
Okay, are there any questions for Jim? Yeah. Okay, let me get over to you so we get it on the audio.
Not necessarily a question, but if you're looking for additional ways to trade volatility, Larry Connors, you can Google Larry Connors. He developed some great strategies that have a defined set of rules for doing volatility trades. They're called Connors VIX reversal trades. And you can Google that and you can look at the rules and look at the results that he reported at the time he developed the trade methodologies.
It's an extremely difficult area because I've observed that a lot of people develop these VIX trading systems and they backtest really, really great. And they work great for a while and then they fail. Now, I'm not saying that's the case with Larry Connors, but I'm asking, have we checked that recently?
I use the CRV3 methodology and it works pretty well still. So, and he's I'll trade I trade pretty much the same as Jim, so I'll do the UVXY or the SVXY.
This actually is a modified Larry Connors system.
Oh, okay, great. Are those publicly, is that publicly available or is it a,
You just Google it and it's well taught. And, yeah. Larry Connor's fixed reversal systems.
see, yeah. And well, that's great. I mean, I would love to see, to hear it. I'm going to look into that myself. Now, who has any more questions for Jim or for Tom for that matter? Okay, let me get over to Mark here. And
so I just had a question about all this. I really haven't traded the VIX too much, but could you not use the SVXY as a hedge for your long stock portfolio and just get a low entry, you know, when the VIX is low, and then wait for the market to fall apart and your position should go up?
Well, this is short.
Okay.
So if you
Maybe you want UVXY then.
crash, yeah, you'd be after UVXY.
Okay. Okay. Great.
any more questions? And again, going back to basics is fine. If people have not, caught some of the details, please feel free to go back to start.
So I don't trade this, and so probably a basic question, but it sounds like you're shorting the VIX in essence, right? So then you're wanting this method is going to work when the market's going up.
That's correct. Right. This will work on an up
but
market.
the rules will take you out of it when the market goes in a downtrend.
Right. When the market falls, the exit rules will come into play.
Sharp enough to get you out when they reprice the SVXY on that overnight repricing in, was it February of 18? When they valued
well, this
off
system,
90%.
yeah, this system was out like a week ahead. The volatility built up over a period of time. I mean, we could go back and you can look at it.
People.
Yeah.
Splits should never make any difference to any system.
No,
Right.
This was a repricing. They repriced it down. I forget what they cut it at. They
Still should make no difference.
cut it in half.
Still should make no difference.
I didn't cut the share price, just cut the price in half.
Still should make no
Oh, it made a huge difference.
not to existing contracts. You're never going to touch existing contracts.
Right. No, the price just fell overnight.
The price fell.
Right.
Oh, I'm sorry. I thought you meant the.
Right. The XI, I remember because the XIV closed at 100 and I bought some in the aftermarket at 80 and it opened the next day at 6.
Oh, the crash. Yeah.
Yeah. So it was, they have to make the trades that they have to do every day at the close, I guess at 4:15 or 4 o'clock. The prices were so high that basically, they lost all their money that day. There was just a spike in volatility in the aftermarket, and they were caught, and all the money was wiped out.
Well, I just love this. We used it all the time for, for both Jim and for Tom. And I have a lot more material. We'll do it in some other meetings some other time. And if people want to trade, get it started in this, how could they get started, Tom, if they just want to dip their, feet in the water?
Question.
I mean, presumably VXX is a simple option. Well, I don't know.
I mean, I would start simple and just make sure you understand the underlying what it is, and then you can pick most any option structure that you understand, a credit spread or a butterfly, and just keep it small and see what happens.
Great. Let's have a nice hand for all of our contributors. We're going over to Cameron Bar and Grill for those locally here, and to discuss this some more. And I think we could have quite a good discussion.